Hey, well, welcome back to number two in our little exercise on fraud and corruption in public procurement. For those of you who are watching for the first time, and I hope that's almost no one because you should have watched video one first. But for those of you watching the first time, my name is Mark Pritchard. I believe, I'd like to think, someone who knows a little bit about fraud and corruption. And we're looking at the specifics of public procurement. There is a video one, as I said, so please, if you are watching this, please go watch video number one. I'm head of a little group of people here who kind of work and sometimes don't work together on these kind of topics for various people such as UN agencies, the World Bank, and so on. What we're going to be looking at really is a continuation of video number one, which looked at the different stages in the planning process, and when we say the planning process, everything here is related to procurement, and everything here is related to government procurement, so public procurement. So we're going to be looking at some of the items there. In video number one, we kind of looked at what the different stages are and what happens at the different stages. And in fact, the next slide is going to actually be a revision of very, very simple. Be good if I get this right, wouldn't it? It's going to be a very simple revision of the basic procurement process. But we looked at that, and there will be a video coming on kind of more complicated procurement processes and how we actually procure things like bridges and hotels and so on. Right, so how do fraud and corruption occur at the various points in the process? And really what's coming up is after this slide and after the next one, there will just be a laundry list of all of the stuff that kind of goes wrong. And we try to organize it for you, and then there's a little roundup at the end. One little exception to that is the next slide, and the next slide will be a revision of a very simple procurement process. So, slide number one, my name's Mark. How do fraud and corruption arise in public procurement? And we're coming on to this kind of laundry list, which we try and organize for you. And hey, if we can do anything for you, please let us know. Okay, there you go. See you on slide number two. Okay, so here we are at slide number two. Right, this is just a very, very simple and basic look at how the procurement process works. We really should do this either separately, because it really is quite a long talk if we're going to make it much more complicated. Or we certainly should have done it before part one, but I only kind of realised when I looked at this that it kind of needs it here. So here we go, bang in the middle at the start of part two. It's a very, very simple procurement process. And this is a procurement process that you'll see in normal companies. Once you start getting into construction companies and people who are buying big time stuff, it's going to become a lot more complicated. But let's just start. Nice simple little government department. We'll start with a thing called a requisition. And this is your standard setup for things like Oracle and SAP and so on. So what will happen here, I've got the project manager, my background, United Nations project management. So I'd say the project manager. So the guy who's actually out in the field, who's running your project, whatever it is that he's doing, he decides that he needs a new phone, a new computer, whatever, and he will request that. So usually what will happen in principle is that the project manager will have to fill in the requisition. So the requisition is this idea of a request. So you have the box on the left-hand side on the slide is the requisition. He will enter into that also what it is that he wants, and he will enter then into the codes. The codes being what's his project number, what's his budget number. In other words, where is the thing going to be charged to? If it's something fairly simple like a computer and he knows what his budget is and he knows what the price is, then he may put the exact price in. If not, or he doesn't really know what he needs, and you sometimes get this, project managers are told that someone's coming and they're going to be needing the camera or something, so they just say it needs to be able to do whatever it can do, and then the purchasing department the procurement department will undertake that itself. So this is going to go into the computer. It may be an exact cost. Again, if he knows that he needs a Samsung or an iPhone or something, he can probably find virtually the exact cost. If he doesn't, then he'll just have to put in an approximate cost into the requisition. At that stage, you would always get it approved. Now, normally the approver will be someone who works alongside him, and that approver will want to see that it's in the procurement plan. So therefore, in the plan somewhere, we buy a computer, we buy a phone, we buy a camera, whatever actually is needed. Well, there is some ubiquitous code that relates to purchase of sundry electrical items. So we get this idea that it's approved. And normally at this stage, the approval will not necessarily need or have to have any levels. It depends what the process is in your company. When we say levels, it means there will be a maximum amount that people can actually approve up to. and that will depend on their job function, their departments, the budgets they have, and their grade, level of experience, and so on. If you set those levels in at requisition, so the person who is approving the requisition is limited in what they can approve by their experience, by their age, by their job title, and by their budget, then what will happen is at the purchase order stage, it will become almost automatic. But you certainly want to have someone who is actually exercising proper control over the process at some point in there. So therefore, we have this idea, and if you look at the slide, let's just read the slide. It says, therefore, the project manager requests the item. That will match to the procurement plan, so we will have an annual procurement plan that shows us that this item is in there, or some group of items, whatever. If it doesn't, you're going to have to justify it, and then someone will approve it. And that person may or may not be limited in the funds they can approve. In terms of your cash management system, you may find as well that it blocks funds. So let's assume it's an iPhone, it costs $500. What the system will do is it will go in and it will earmark $500. So you will have available funds to spend in terms of cash that the project has, and that this will earmark $500. That happens in some organisations. It doesn't happen in others at this stage. Again, most of the organisations I've worked in, it does. And the one thing you do need to be careful of is that if the person says, "Oh, I need an iPhone," and then the guy who's leaving is just giving me his, so I don't need one now, you need to delete the requisition, because if you don't delete the requisition, then that money sits. You've got $500 sitting in your bank account. So we've got this idea that that's how it starts, the requisition. In general, what you find in larger organisations, if you're looking at big UN agencies and so on, that this is happening at the project office level. So you have a project that's running somewhere in DRC, in Congo or somewhere, and therefore the guy needs an iPad. His supervisor or someone who works with them on the project says, yes, we always knew we needed an iPad, and they said the requisition will then go to the procurement department. Once we get to the procurement department, then we hit the idea of the purchase order. So the procurement department will demand certain documents which will enable them to process this thing. So purchase order, they will click a button that says generate purchase order, and so the system will automatically generate a purchase order. And all that the purchase order does is it just copies over the information from the requisition. So all of your account codes and so on get copied across. The person who will be your purchase ledger clerk, he or she will then ensure that you have the correct backup, so they can identify which project it goes to. The system itself will check that the project has the budget in it, and it will check that the bank has enough cash in it for this. And then the person in the purchase order department will also see that it's been approved by the right person, it's going to the right place. And there's correct backup and justifications for it. When you get to sort of larger items, you may find that you need 3 different suppliers. So you may find that they've shown that 3 different shops sell iPhones. If you have a long-term agreement or something that says you have a permanent contract with one supplier, then it may be that one supplier is enough. But your purchase ledger clerk will check that the correct procedure has been followed and that that's been correctly documented. Again, in very large organisations, usually at this point what you can do is you can, awful noise is my phone, that you can upload the documents into your ERP system as well. And so the ERP system has not only the purchase order, but it actually has the documents that back up the purchase order. And that makes it easier for the auditors, assuming that you want them to have access to your ERP. Your purchase ledger clerk will then, having approved it, him or herself, will pass it to a second person, and the second person will be able to sign off with final approval. So usually it will be the head of the procurement department, or it may go back to someone else who works in project management group who knows something about this particular project. The key fact is that between those 2 people in procurement, that one person should have some knowledge that this thing is actually required, what it is and why it's needed. Once it's double approved, then the purchase order will be generated. Right, that's a very, very important step because it's called a purchase order, because in automated systems, what will happen is that the computer will send a copy of that purchase order to the chosen supplier. So the chosen supplier, therefore, is getting this copy, and it tells them to deliver the iPhone to the specific place where it's being delivered to. So it's an order, and it will say in it the price and the terms. And obviously, if you have a long-term agreement, an LTA, with one particular supplier, then they will know what the terms of reference and so on are. The copy of the purchase order or confirmation of the purchase order will go back to the person who raised the initial request so that they can see that procurement department has done its job and that they've moved the thing along. And there will normally be a third copy kept for records as well. So your purchase order, one copy will stay with the purchasing department, one will go with the requisitioner, and one will go to the supplier, assuming that everything is automated and works well, which we all know, I think, that it doesn't so often. What will happen then? So stage number one was the requisition, where we got our documents and we kept a copy of the requisition in the original requisitioning department, and a copy will be kept in the procurement department. Your purchase order now goes to 3 different places. One of those is the supplier. The supplier now sends the goods, and those goods are actually delivered. Right, that is an absolute critical moment. What happens at the point of delivery is that somebody, presumably from the original project, will go in and say, yes, we have received these goods. So when the goods actually arrive in the project office, someone will have to go in and will have to click the delivered or received, whatever you call it in your system, box. That's really, really important for numerous reasons. The most important, I say arguably the most important reason, is because once the thing's been delivered, it's yours, so it's actually your responsibility. So if somebody signs to take delivery, walks across the office, trips and smashes their new iPhone, it's your fault because it's your goods, yeah? So what's happening there, therefore, is we've got this idea of being delivered, and legally now the item actually belongs to us. Other things that will happen are the accounting system. So therefore, in your accounting system and in your asset system as well, the iPhone will now be registered in your asset system as one of the company's assets. For accounting, therefore, delivery will start, so potentially, therefore, depreciation starts within the account, and so on and so forth. So this idea that we get the thing and we take delivery of it, and the date that it's delivered on goes into the system. The goods received note that we talk about is just a document to say that this is what's being delivered. Again, if you're buying stuff from Amazon, your goods received note and your invoice are actually the same thing, but there's a bit of paper in there telling you what it is that you've actually got. Right, so that's stage number 3, and then stage number 4 is that either the goods received note will double as an invoice, or you'll get an invoice to the post, or you'll get an invoice with the goods, which is a separate document, or you'll get something by email, but you're going to get a 4th document, and the 4th document is the invoice, and that invoice needs to be paid. Please notice the difference here that the invoice, while a copy will go to the procurement department, and it's probable that a copy will go to the requisitioner as well, just to show what the final total cost was, so that they can see it crops up as a project expense or an asset in the project. But notice that we keep it separate. So we keep the people who are buying the goods and the people who are paying for the goods separately. So that separate person will be the finance department. The finance department will check that the invoice is in order with local VAT rules and so on. And then if you're really lucky, they'll pay it reasonably quickly. Okay, that's a very quick run through a very simple form of the system. But I think it's quite important to do that. If you have any questions on that, you know where we are. Please contact us, and a lot of you now contact us. We do get this stuff. So find us through the website, and then you can ask about this stuff. But that should all be fairly straightforward. I hope most people actually know that. Okay. How do I stop this? Okay, so slide number 3. So what we've got now, this is a bit juicier and a bit more fun, to be honest. Now moving away from just a basic procurement system, because now we're looking at the actual perpetration of crimes, and they actually are crimes as well. So let's just have a little look at the list that we've got down here. A little look here at the list that we've got. Sorry, my computer just did something funny. It's flashed up there. Right, so starting with looking at the bids. Right, the first one is bid manipulation. Bid manipulation is usually the situation where you have bidders for a contract. So in other words, you have a company, the company wants to, or a government organisation actually, of course, government procurement. So a government wants to build a bridge and it puts out the tenders. What happens then is that those companies which are bidding to build that bridge begin to work together. So we get this idea of bid manipulation. So we've got the concept of bid manipulation, which is where the bids are being put together. In other words, the companies get together and they put in bids, and they manipulate those bids It goes again hand in hand with this idea of bid rotation. With bid manipulation, usually what you're trying to do is you're trying to ensure that we know who's going to win. And let's be honest, when you're a tendering company and there's some big tender process, tendering is a pain in the neck because it costs a bloody fortune to do. And then if you don't know if you're going to win or not, why would you spend 3 people working for 2 weeks to prepare a bid? Because it takes a huge amount of time for these big international tenders. Then you don't even get a call back to say that they've looked at the damn thing. So with bid manipulation, what's happening is that companies are working together, and when they work together, the object of the exercise is to know exactly who's going to work for, exactly going to work for the bid. Where we get bid rotation is effectively the same thing. But let's assume that you've got a project, and the project is to build a car park, and then next to the car park to build some shops, and then around the shops to build some landscaping in a park. So you've got 3 phases. You've got 3 companies, and what they do is that they ensure that company number 1 wins stage number 1, company number 2 wins stage number 2, company 3 stage 3. And so it's the same process as bid manipulation. You've just got companies working together as groups, and then they are ensuring that we know who wins. And often what happens is that we get this idea that they take it in turns to win. And certainly one of the courses that I worked on had some nice little exercises that shows you this. And this ties in with the thing at the end here where we have this idea of cartels. And that's what cartels are, where you are trying to ensure that there is a limited number of companies that win all of the bids and that they work together to ensure that they do, or they will get together to talk about the bid and ensure that they all bid prices which are very, very high, so that whoever wins it, they know that they will make a good profit. So it's this whole idea that the people who are bidding for contracts are working together, and the object of working together is to make sure it's a nice little profitable business for everyone involved. So we get a business just like that. Rigged specifications is very, very slightly different. Rigged specifications means you have to have someone on the inside working, and what they are doing is that they are rigging the specifications so that we know who's going to win. Where we get examples of this is where you would say, okay, we're going to bid for a training contract in fraud and corruption, but you can only bid for it if your initials are MFP. So my name is Mark Fielding Pritchard, my initials are MFP, so that's very good for me. Some of the guys that I work with in other places can say, but how are we supposed to bid? And who knows, they may be able to do the job better than me, but they won't be able to bid because my friend on the inside has rigged in my favor the specifications. So that's rigged specifications, and it goes hand in hand with bid suppression. Bid suppression is the situation where we have a company, it's a very good company, they are going to bid for a contract from the government, and we suppress their bid because we don't want them to win, because there is someone else who is due to win. Where you see this a lot in real life, and again, it's this idea that people aren't really setting out to be master criminals when they do stuff like this, is you have a project, you know that the person that you want is available at that time, you know they'll work for the price you're going to offer, and you say, right, we know we want this guy, but it has to go through the tender process. As part of the tender process, you suddenly come across a CV, and it's someone else, you never heard of them, no idea who they are, but they look on paper really, really good. And you think, oh, but I know I want Dave or Steve, this guy's really good. We'll just push his CV to the side, and we'll get some crap people, and then we'll have 3 CVs, 2 of which are crap and 1 of which is really good, and Dave or Steve will get the contract. So, and that's an example, a very, very simple example that happens all the time of bid suppression, where this guy looks really good, so let's just lose his CV. Whoops, fell into the bin. But it happens big tenders as well. We know we won't work with them 4 nice guys, and then someone else comes along and they look a wee bit good, or they're a little bit cheaper, so let's try and lose their bid somehow. And it works again with this idea. You have to have someone on the inside, so someone in the company which is issuing the tender document working with you. So we've got the idea of bid manipulation and rotation, which kind of go together. Specifications and suppression go together, and cartels goes back to the first idea. The missing one down there is bribery. I hope everybody knows what bribery means. You are working for a company, the company sends out a tender, and someone comes to you and says, I want to win the tender, please have some money. And you say, oh, thank you very much. and you take the money, and in return for taking the money, you do what it is that's required to earn it, because you are earning it. You're being paid for a service, and the service is to read the specifications or to sit on the tender committee and say, oh, this guy looks really good, but whatever it actually requires. I don't think anybody needs much of a definition. Okay, so we've got there 1, 2, 3, 4, 5, 6 little things that happen, and at this stage we're talking about at the bid stage. There you go, nice and easy. Hey, so slide number 4, and it's just kind of more of the same. In fact, all the slides up to the end now are all just a long list of these things, which I told you at the start. So on slide number 3, we started looking at some of these things about bidding, and we're just going to continue. Right, the first 2 on our list, so here, if you have any questions, obviously I can't answer them while you're watching a video at home, but if you have any questions, please send them to me. The first 2 on here are fairly similar, they kind of tie in together. Alright, and it's a little bit of repetition that you've got here now. And I guess the third one as well. So market sharing is this idea that we have collusion, so we have bidders working together, and the bidders will just work together to simply divide up the market. So one company will say, okay, well, I will bid for this government contract, the next one says, I will bid for this government contract. And what's happening is you've got a group of guys sat around the table, they're looking at a group of tenders, and between them they're making decisions on how the tenders will go, how they're going to divide up the work, and the object of the exercise for them is that they divide it up, and however they decide is equitable, and we all make a nice profit, which sounds good, doesn't it? The problem with it is that the government, as a tendering organisation, ends up paying too much money. So we end up paying too much. And so that's what market sharing is. Market sharing is this idea of just dividing things up through the process of working as a cartel. Price fixing, which is number 3 in your list, is broadly very, very similar. So we've got the several companies working around and saying, okay, well, I will put the price of this to this, I will put the price of this. And again, the object of the exercise is to make sure that that we all make a good profit. And again, that's bad. It's bad because no transparent market, so we don't get best value for money. Complementary bidding or cover bidding is part of the same process. Cover bidding simply means that we know that this guy over here is going to win, and we know that to build the bridge is going to cost $30 million. So I prepare a tender and I put my tender in, and the tender is for $40 million. The point of it is that to be a valid tender process, you must get a certain number of tenders. So therefore they have a tender from me, and presumably I meet the initial criteria, so I've gone in. But the aim of it was never to win. We knew that we wanted my mate from the bar to win, so I just bunged in a tender, and there are some technical problems with it, or there are some pricing problems with it, but at the end of the day, it was never going to win. We knew it was never going to win. But this idea of submitting tenders makes the process itself valid, at least in the eyes of, hopefully, the auditors. And so therefore we know who's going to win. We get this sometimes. It does sometimes happen as well. You see it. I've certainly seen organisations desperately asking for bids, because if they don't get bids, then they can't do what they want to do. So you are an agency of some government body, and you want to run a training course, and you put the thing out for tender, and you get 5 bids from hotels. You want them to be the venue, and you choose hotel number A. Let's now jump forward 3 years. You've had 20 training courses, and every single training course has gone to hotel number A. What will happen is that the other hotels will go, we're not going to submit a bid, we never win. Come on, you've got to throw us a bone, give us something, or we're not going to do it. Then what happens is you have to get someone somewhere to start tendering so that the process has validity. Otherwise, you can't have your training courses anymore. And in fact, usually what you will end up doing then is writing a note which is some form of a waiver and giving it to another hotel just to keep the others in the game. So complementary bidding or cover bidding is this idea of submitting tenders which were never ever designed to win the process. So we've got market sharing, dividing up the market, price fixing, which is the same thing. We're just setting the price rather than working out which tenders that we're all going to win, which is the same thing. And then complementary bidding, people are submitting tenders that they know are never going to win. Number 4 down there moves to a bit later. We've got product substitution. Right, this is what actually happens later on. where you have an organization and they submit a tender and they say we're going to build a bridge, and I know nothing about bridge building, but we're going to use this type of concrete, this type of bricks, this type of steel, whatever else goes into it. And then when you actually do the contract, so in the execution of the contract itself, you use substandard products. I think we talked about this in lecture number 1, in the first one. And what happened in number 1, as I told you about training companies, very, very popular with training companies. You get training companies will come along and they will come to people who are internationally renowned experts or have lots of experience working for, World Bank and the UN and so on. And they say, can I put your name in a tender? And you say, yes, you can put my name in the tender. Then later you discover that they've won the tender, but they haven't used you. They've used someone else who is much, much cheaper. So your name, reputation, and goodwill wins that training company the training contract, and then they go and get a local, and typically they get a local person, and the local person who is in wherever will work for a considerably lower daily rate than you want. So your goodwill gets the contract. Again, what you often find happens now, because obviously so many people, particularly the EU and USAID, have got so wise to this, is that what they do is that they say, if you do that to us, then we will cancel the contract and retender. So that stops people from doing it. And again, with training companies, you have to find a balance. They'll phone up and they go, can we put you in the tender? And you go, yes, and you forget about it. And then 4 months later, they come back and say, okay, we need you to go to Kiev for 2 days. So we'll pay you whatever we're going to pay you. And you think, Kiev, 2 days? I've got another project on. Don't want to lose 5 days, because that's what it really is when you take into account planning and travel. It's just not worth it. No, I don't want to go. So there has to be a balance between these things. Okay, product substitution. Inserting into your contract cheaper products or cheaper people. Finally, purchases for personal or for resale. This means here personal use or resale. What's happening is that the person who is issuing the tender is intending to take a certain part or proportion of the goods and services and use them for themselves. Seen this so many times. Government organisation wants a hospital built, and spookily enough, the guy who's having the hospital built gets a little country house or an extension on his house because there were some spare bricks left over, which morphed themselves into a fully functional extension on their house, or even a completely new house. Even in places you wouldn't expect to see it. Yes, that's right. A company comes in and they're going to be doing major refurbishing work in an international organisation, and the gentleman handing out the contract just happens to get a new kitchen out of it. And so we've got this idea that as part of the contract, the person doing the tender is going to get some goods or some services, and those goods or services are either for personal use, or if they're goods, they can resell them. So who knows, wherever you're providing shoes to people who are in wherever Uganda, and we get 20 pairs of shoes for ourselves, which we can sell in our wife's shoe shop. So it's stealing. At the end of the day, this is just a function of bribery, and it's something that we should all work to try and stamp out. It happens. It happens all over the world, and just as much in developed countries as undeveloped countries. If you know about it, then go to your whistleblower line and start reporting it. That's what you need to do. Okay, I think they're all fairly straightforward, aren't they? Good. Sure. So be careful with the examples, that's all. See you in a minute on slide number 5. Okay, so we're now up to slide number 5. Slide number 5, and again, I think we've covered some of this stuff in the first part of the lecture, but it's worth going through again. Right, the first one is split purchasing. Split purchasing is the idea where you are entering into a contract, and for whatever reason you split your purchasing. There you go. Get an explanation of the name. If you're buying a car, you wouldn't expect to buy the car from Mercedes-Benz, but buy the seats from Ford, for example. So split purchasing is this idea when you split contracts between suppliers. Your concern when you're looking at this, when you're looking at fraud and corruption, is that we're specifically trying to give part of a contract to a supplier, or as often happens in kind of trade wars, we're specifically trying to take away part of a contract from a supplier. And the effect of that action is negative on the organization. We want as smooth, as quick, as efficient as a procurement process as we can, so that we minimize all of the costs and so on and so forth. So split purchasing is the idea where we're splitting things, and logically they shouldn't be split. You wouldn't expect to buy 20 new computers, but to buy the keyboards from someone else or the monitors from someone else, unless there was a really, really good reason for that. So split purchasing, where we're breaking up contracts. And you can get the opposite as well. And it doesn't actually seem to be there on that slide, but where we get the opposite, where we combine things. So you buy computers and you also buy postal services from the same company, and it makes no sense whatsoever. Why would you ever do that? Why would Best Buy or Eldorado or someone ever deliver your post for you? And it's just because someone somewhere has seen a profitable little part of a contract that they want to dig out for themselves. You need also as well, I guess, just to expand that point, because we do see that sometimes when you're undertaking contracts, particularly as when we're doing intellectual work like we do here, some parts of the contract are really good fun, and you tend to find that the fun bits tend to pay the best as well. And then other bits are really boring, writing those final programs and stuff. And so you'll find that people will cherry pick. You get guys who been around the office a long time, a lot of friends. Oh, I'll do that bit, but just go get Mark to do that bit. That looks a bit dull for me. So again, are we splitting things for personal reasons rather than just the best person get the job and so on? So we would just look at that. So, akin to that as well, unjustified sole sourcing. Sole sourcing is this idea that you just have one supplier. So we don't get 3 quotes and then compare the quotes. We don't bother drawing up all of the tables to compare value for money and so on. We just go to one company and we say to them, do this for us. And the question would be, why would we do that? In real life, you often do it because you have an LTA with a company, and they offer you a good product at a good price. And so therefore, the point of going through a constant tendering process, the cost of that process is greater than any cost savings you would. So I worked in an organization, and all of the computers came from Dell, and everywhere in the world it was Dell, and they just decided that it was so much quicker to just sign a contract with Dell, and I'm sure that they were giving a good price and good product, etc., than it was in all of the offices to go through, well, will we buy an Apple, will we buy a blah, blah, blah. And I guess the other thing as well was Apple and Microsoft, you had problems of compatibility and so on. Right. In circumstances like that, I had no pretense that there was anything other than perfectly well justified and a very good procurement decision. But sometimes it's unjustified. So why ever would we do that? Why would we just go to one company? And if you are going out for a one-off tender because we did this at one stage, if you're going out for a one-off tender for 1,000 computers, well, why would you just go to one company for 1,000 computers? You wouldn't. You'd go to 3 or 4. And see what they could supply you in terms of quality, quantity, features, and so on. So we are looking for sole sourcing contracts are always to be looked at, and they do get them. And best examples I saw down in the South Sea Islands and the Marshall Islands and places like that. You want to run a course on an island, and you go, okay, we need to find a hotel, and you go there, and there's one hotel. So bingo, either you're doing it in the street or you're in the one hotel. So it's kind of justified. You can't bring a hotel from another island. If you're buying computers and you're buying in the middle of New York, no reason why you're not going around multiple suppliers. Other things to look for: fictitious suppliers, so suppliers who don't actually exist. This happens in real life where you usually have someone in the company, and they know that they can buy 1,000 computers, and each computer is going to cost them $1,000. So they invent a supplier. So the supplier gets invented, it quotes $1,100, and then you just have Dell deliver them for $1,000 each, and then you just add the markup, and that's purely your money. So this idea of fictitious companies, and this happens all over the world, and some of the international organizations get caught with this. They go into sign a contract with an NGO, the contract gets signed, they pay sum of money up front as the first tranche of cash for work to start, and bingo, the money disappears and the vendor disappears, and you go along and there's their office and it's a garage, So fictitious vendors, fictitious supplies, and we can look at background checks on these things because there's a standard procedure you should go through for background checks. and looking to make sure that they have a presence, they have a physical building, and so on and so forth. So the idea of vendors that don't exist. And the other one is ghost and shell companies. Offshore shell companies, very, very useful. Certainly, in the consulting business, you're traveling around the world all the time. Sometimes it's legal. Sometimes it's perfectly legal to get your money paid into the British Virgin Islands or somewhere. So you have a shell company there, and there's a reason for that. Reduction of tax as well. Lots of companies have leasing companies and so on, which are registered in, well, even in the good old days when I was doing tax, they used to be registered in the Netherlands, but they're registered in Jamaica or somewhere. Big major companies. Also, insurance companies, you pay insurance premiums, and you own the insurance company, and it's just a shell company that gathers cash. Because if you're deducting your insurance premiums for tax purposes in the United States of America, you get a tax deduction of 40%. It goes to British Virgin Islands and no tax at all. So it's out of the tax. Right, what you're looking for then is you're wanting to know why the supplier is a shell company. At what conceivable point would a shell company ever be able to provide you with goods or services that you would want in your government? For private individuals, they sometimes do it because it can be ways of avoiding VAT, depending on the local laws. But for the government, I can't think of a reason off the top of my head why you would ever really want to do it that way around, unless you had something to hide. Transferring payments to shell companies means people don't know where they're going to. So therefore, if you're making a payment to someone you're not supposed to be making them to, we can't advocate that, and I would hope you never see that. Okay, so that was a nice short little slide. Oh, that's 7 or 8 minutes. So you've got split purchasing. So we're breaking contracts up, either to take nice pieces of contracts away from people or to give them to other people, and that's the easiest one to understand, isn't it? Unjustified sole sourcing. Sole sourcing where you only have one supplier and we don't go through the tendering process. Why you need to look at what the justification for it is. There are many, many occasions when it's justified. Only companies that can provide the goods, etc., etc. But very often not. So all of them need to be identified and justified in real life. Fictitious vendors, that should leave you with no problems at all. The company just simply doesn't exist. And usually it's because a member of staff in the purchasing department is making a turn on the money. And ghost and shell companies, again, you would really want to know why. Why the hell are we doing this? Why on earth are we buying goods from shell companies? What do they have that we need? And usually they have the ability to hide where the money's going. And that is a huge red flag. Okay, that was, I see those small numbers. That was slide number 5. I think 6 is really kind of the last one. I think the very last slide was goodbye. So, see you in a minute. Hey, here we go. Slide number 6. So just looking through slide number 6. Forgive me for scratching my nose as well. It's the winter. Beard's coming along quite nicely though. Slide number 6. Right, slide number 6 is just more of a continuation. I told you at the start we had this kind of laundry list. I think the only thing just reading this before I began to talk is that I would probably kind of like to try and do this in reverse order. So try and make this a bit more interesting, do it in reverse order. What we're going to do is we're going to kind of start at the bottom. So we started with this idea of the tender process and the fact that tender documents were going out. And we talked about how companies that were going to tender were forming themselves into cartels. And so then we got little cliques forming and they were price fixing and so on and so forth. Once again, some of the stuff that's come up on here, we have seen in other slides as well, even on the last one. So starting at the bottom then, biased evaluation criteria. Right, what happens when you have certainly things like technical skills, so the kind of contracts that we here at Emery Fielding are contracting for, is that they are judging us first of all on our technical proposals, and then secondly on our financial proposals. So we can still win a contract even if we're not the cheapest. And generally we don't try and bid too cheap just to win a contract. I mean, if we're really quiet or something, we might do that. Or if it's something new we want to get into. But in general, we won't do that. Right, what we're looking at therefore with biased evaluation criteria is that when you're looking at the technical side of it, and certainly for most of the organizations we tender for, 70% of the evaluation is technical and 30% is financial. So when you're looking at the evaluation criteria, what we are saying is that those evaluation criteria are particularly spiked in a certain direction. So you may find that there are criteria in there that you don't particularly need. So we're going to do a project, and the project is in Jamaica, but you have to be able to speak Russian. Now that would be brilliant because I am fortunate that I can speak Russian. Haha. Вот, по-русски могу говорить. No, but for other companies, what would you need it for? So that's the first place where you see it, which are unnecessary skills that are required. The second area where you would see this kind of thing is where you would twist the criteria. So let's assume that we're going to do fraud and corruption training and it's in Moscow. So then Russian language would be very, very useful. If you have a foreign expert who speaks Russian, that always looks good. But then you find that they put 80% of the weight is on your ability to speak Russian. There are an awful lot of people who can speak Russian who don't know anything about fraud and corruption. So again, while Russian would be important, you would expect to see it as 10. If the client is it's the Russian government and they're very insistent, maybe as much as 30%, but you wouldn't expect to see it as the overriding thing that you know is the language. You'd still expect to see the overriding thing you know is something about fraud and corruption and can make it interesting. So biased evaluation criteria, either we're specifically asking for things that very few people have, and you do see it in I mean proper contracts, contracts with the Laotian government and they want Laotian language sort of thing. Or just this idea of the weighting on the criteria being set at such a way that it strongly tips in a certain person's favor. So doing them in reverse order, the last one on our list, biased evaluation criteria. Next one we've got is restricted bid solicitation circulation. That's not easy to say, is it? Restricted bid solicitation circulation. It means that you only give the tender documents to certain people, and this is another popular one that we see. Once again, we've got this idea that there's a consultant, and everybody knows which consultant we want to come and do the work for us. So that person is obviously told to look on the website, and then what you find, and this isn't so much limited circulation, it's limited time. It has to be on that website for a certain number of days. And people try to cut the number of days, and then they write this stuff like, oh, I didn't know. When it said it had to be up there for 10 days, I thought it was 10 days in general, not 10 working days. So I put it up on the 23rd of December, so it was up until the 2nd of January. When everyone's at Christmas and no. So restricted bid solicitation circulation. We only send copies of the tender documents to certain people. Having said that, certainly most big tenders for government work, we were doing some stuff, fraud and corruption the other day, it's 1.8 million euros. To get the documents to be able to tender, you have to pay. And so what they're doing is they're first of all deterring people, because it's a few $1,000s, they're deterring people who aren't serious bidders. And secondly, what they're doing is they're recovering some of the cost of the procurement process. I thought it was very clever. Lots of people do that. So number 2, I'm going to try and get my teeth lined up. Restricted bid solicitation circulation. I must think when I'm writing these things, huh? Right, next one in our list is unnecessary or inappropriate line items. Right, unnecessary or inappropriate line items is the kind of thing where they add additional items in which are totally not necessary. So you are doing a course on fraud and corruption and somebody somewhere wants you to go for a day and talk about 16th century Mexican art. Complete waste of time. And the reason that they do it, again, is because what you are doing is biased evaluation criteria. So you're putting things into the contract which mean that only certain people can win them. Or the other thing that you can do is you can increase the number of outputs. So we want 5 days of training on fraud and corruption, which is going to take place in Odessa, in Ukraine. But in addition to that, we want 1 day on double entry bookkeeping. Now, most firms that have a couple of guys who can do fraud and corruption can do double entry bookkeeping, so it's not restricting the number of people, but what you are doing is you are increasing the cost. And again, if we know who's going to win the contract, we're just increasing the price that those guys are going to get paid. And so that's what we're doing now. So unnecessary or inappropriate line items. And it goes with the one above, which is inappropriate bundling. Right, unnecessary items, things that we don't need, which are done either to ensure that we know who's going to win the contract or to boost the value of the contract. Kind of things as well that people will ask for funny things at the end of the year because your budget, use it or lose it. Right, inappropriate bundling is kind of thing where, and I think we've seen this, it's where you're putting things together and they shouldn't go together. So we're a government department, we want 500 computers, and in addition to that, we want for the army 10,000 pairs of socks. You would not expect one organization to provide you with computers, mice, monitors, and then socks for the army. And that is inappropriate bundling. You do it because you are trying to set the contract in such a way that we know exactly who's going to win it. And the company which is going to win happens to be a sock company that has some old computers or a computer company that has some old socks, whichever way around it goes. Okay, so the first four therefore are based on people inside the company that are preparing tender documents, and they're doing it in such a way to ensure that we know who's going to win the tender, or we know that these people are going to get more money than they should. Now what we're going to do is we're going to come on to, and this is why I've done this in reverse order, because now what happens is you have a contract and the contract starts and we are getting deliveries of whatever computers or whatever, and the things are due to be delivered. So the people in the organization which is purchasing the goods are whiter than snow. It is the people in the company which has won the contract who are now trying to manipulate the contract to get as much as possible. So this is how we flip there. And that's why I started this at the bottom, because in terms of doing it in time, the bottom four will come before the top three, and not just to make it more exciting for you. So, false invoicing. Right, false invoicing is simply sending in invoices, and the invoices are going in for either items which have not been provided or for services which have not been done. I have certainly seen this happen. We have one contract for one organization, and it was to do some work around IPSAs, so we were doing work, and they organized a second company, and the second company was supposed to come in and oversee the work and make sure that it was adequate quality, blah, blah, blah. And the second company, I don't want to use the word audit because you'll automatically think Big Four audit company, and it wasn't a Big Four audit company, it was a small company. But they were coming in to look at various projects to ensure that those various projects were being done correctly. We never saw them. I think one guy turned up for one afternoon for an hour. But then what happened was that the main organization, the main agency, said, okay, well, these are the timesheets that we've got from these guys. Can you say, because they put down on here that they've worked with you, and it was a lot. You know, we worked with you for 30 working days at however many $1,000 a day. And we went, no, I have never even heard of these people. I only know this guy, and this guy's been here for an hour, maybe 2 hours, one afternoon. And I've seen him, and I actually met him in the foyer of the building a few times because I knew who he was. That's false invoicing, and that's a huge problem in real life. One of the biggest organizations we're always reading about that seems to get hit with this is the American military. I mean, the American military, I read somewhere, was billed at one stage that one individual man did 3,000 hours of work 1 month, and I think people were just submitting invoices and they were just going through. So you can Google that one in front of the American military. So false invoicing, we're submitting invoices for goods or services that have not been provided. And people, because they're in procurement departments which are separate from the project department, are just not checking this stuff, they just sign them and pay them. Right, manipulation of deliveries. Manipulation of deliveries means, as the name suggests, that we change deliveries. Where you get this a lot is when you're in places like Africa. So let's assume that the contract says that we will give you, we will give you a couple of $1 million and you will provide us, I can't even do the math, so let's just call it 2,000 washing machines. So we get a company comes forward and they say, okay, $2 million, we'll provide you 2,000 washing machines, and we will deliver them to, let's assume it's a refugee camp so that men and women can wash their clothes. Then what happens is you pay them the money, and what they do is they pay the money up front and they delay the delivery. Right? Why are they doing that? Because what happens is they get your money, and then with your money they take your money along and they buy the washing machine. Now that's not what you pay for. What you should be paying for is for them to deliver the washing machines, you get them installed, you make sure that they work, and then you give the guy the money after. That there is a timing difference between his provision of washing machines and his getting the money is his problem, and he can microfinance it, he can borrow the money from the bank, borrow his money from his friends, who cares, not your issue. But what he wants you to do is to pay up front, and then he'll buy the washing machines after. This was actually a system that I saw that worked, and it actually was designed to work like that. When I first lived in Russia, I was sharing a flat with some people, and we decided an apartment, and we decided we were going to buy exactly a washing machine. That's where I got that from. So there was an ad in the paper, washing machines. We phoned it, and a guy came around and he had a catalogue, and we chose the washing machine. We paid him on the spot, and then he arrived a month later because he'd ordered it from Finland. And when he'd ordered it from Finland, he then installed the washing machine. We had no problems. Great washing machine, great guy. We got everything we wanted, so it was good. But that's what we were doing. We were paying in advance, and he was bringing it over the border for us. Right, that's manipulation of deliveries. So deliveries, you can have different volumes delivered to different places at different times, and the object of the exercise for the supplier is that they are trying to increase their profit margin on the contract. Final one is abuse of contract variations. Right, contract variations are where you make changes to the contract after the contract has begun. Any major contract will have variations. Consulting contracts, particularly when you're doing work for the UN or USAID, you go to the client wants 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, so these 10 different things. Then what happens is that when you begin providing the things, he decides he doesn't want number 8, but he wants something else instead. But that requires more money, or it requires, even less money, but we don't normally try and tell people that. Or it requires a different specialist, you can't come on, da, 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 da. Right, what will happen is that the supplier will very, very often try and change the terms of the contract. And we've already talked about this. One great example in the teaching profession is, well, we said you were going to get this guy who was going to fly in from Scotland and who's worked for 20 years in Russia. But in fact, no. In fact, you're going to get this guy from the local college who's worked for 20 weeks. And, the guy could be really good. He could be fantastic. But he's not what went in the tender, and he's not what was paid for. Again, as a procuring organization, you have to weigh up, are we going to go through the pain in the neck process of purchasing this stuff again? We're just going to take it on the nose. Or, the choice of what those two things are. Cancelling the contract, redoing the procurement process, or do we just take it on the nose and maybe, if we can, try and cut the cost of the contract? Okay, I don't think that's a difficult one. Abuse of contract variations. Variations are changes to the contract that happen after the contract has begun, and your supplier will try to get you to either increase the price or lower the quality or volume of the goods. Okay, that was slide number, those tiny little letters. I think that was slide number 6. Then we still got slide number 7 to go. See you in a minute. Okay, slide number 7. Let's just get this one finished off, and I got to go and pick up my daughter from school. So we are just continuing. It's in the same vein. I told you before that this is just a long list of stuff that can go wrong and the stuff you should be looking for. Again, I think there's a little bit of repetition here as well. Right, unbalanced bidding. Unbalanced bidding is an interesting one. Fascinating to see in real life. Unbalanced bidding means that what you do is you change the particular value of individual line items. So it's like I said to you before, let's assume that phase number 1 is to build a car park, phase number 2 is to build a building next to the car park where there will be shops, and phase number 3 is to do some landscaping. So you've got phase 1, phase 2, phase 3. Okay, hope that's clear. Then let's assume that each phase we think has an equal cost. So $40,000, $40,000, $40,000. So therefore, building the car park will be $40,000, building the building will be $40,000, and landscaping will be $40,000. Gives us a total of $120,000. Right. what can we do? Well, let's assume that we change it. So when we put in our bid, we put in a bid that says the car park will be $50,000, the building will be $50,000, and the landscaping will be 20. So instead of 40, 40, 40, we've gone 50, 50, 20. So we're overcharging for the car park, we're overcharging for the building, and we're undercharging for the landscaping. Right, what do we do then? Why would we do that? Well, we do that for two reasons. The first reason is that we get paid much faster. So by doing this idea of changing the line items, we get paid 50 up front rather than 40. So that helps our working capital. So if we've got other projects, we can use the money on other projects. Again, if you remember, it was the car park, now it's 50, and then we've got the building is 50 and the landscaping is 20. So that's the first thing we can do. The second thing that we can do, if we have someone working on the inside, is when we've built the building, we can go back to them and we can say, let's not do the landscaping, let's just cancel it. Right, if we cancel the landscaping, we've kept the overvalue, because it was 40, 40, 40 is the real cost. So by not doing the landscaping, we've saved 40, and we won't get paid the 20, obviously. So we can do that idea, therefore, but we can bribe an official to cancel the last part, and we can save money. If you want to really take it to the nth degree, we can build the car park, we can build the building, and then we make our company bankrupt. So we pay a huge bonus to the directors, company has no money, and it goes bankrupt, and so it can't fulfill the final part of the contract. And so we have this idea of this unbalanced bidding, where we are swapping sums of money between different lines in the contract, and we do that to maximize our profit and also speed up your cash flow. If you have a company that maybe has some issues with cash, then it's a good way to get some cash up front. Yeah. So when we are preparing our tender, we play around with the individual line items so that we get a better deal overall. Right, that's number one. Number two, leakage of information. So what's happening is that when the process is being run, is that certain bidders have certain information, and that leakage of information will be coming from people inside the organization. So you pay someone a bribe, they say, okay, the tender process closes tomorrow, and they tell you what the lowest price is, so you can come in at $1,000 under, and you automatically win under the rules. Right, so leakage of insider or contractual information works collusion between bidders and staff on the tender committee. Exclusion, we've seen most of these things before now. Exclusion of qualifying bidders, so we don't circulate to them, we put special terms in that they can't meet, we suppress their bids, but someone who is a really good quality bidder who would do a great job for us is specifically excluded because we don't want them anywhere near the process. Next line down, inappropriate contractual terms that we've seen already as well. So we put this line in that you're going to teach in Jamaica. So to teach in Jamaica, you must be able to speak Ukrainian. Absolute nonsense, of course, but the point is that it keeps other people who would be well qualified bidders out of the process. So number one, unbalanced bidding, I think is new, we've explained. Leakage of insider information, you should know already, it's pretty easy. Exclusion of qualifying bids, we've covered. Inappropriate contractual bids, inappropriate contractual terms, we've covered. And then finally, you've got this idea of bid tampering. So what happens is, again, it's usually somebody inside the company. They will go, they will open the bids, and then they will, they'll take pages out, they'll change the prices to make your bid cheaper, but you're bribing somebody to play around with the actual bids. So then when the bids go to the bid opening and when the bids go to the bid assessment committee, of course, the person who's paying them wins. So we get this idea of bid tampering, and there's nothing sophisticated about that. Just good old-fashioned change the documents and my mate wins. Acceptance of late bids. So acceptance of late bids is, as the name suggests, everybody puts a bid in, and then this guy comes, and it's the day after. And can I just say that it is so annoying when you get sent something, you're working on a tender, and then you look at it and you think, crap, the deadline was yesterday, I've missed it. But acceptance of late bids is where we get organizations accepting late bids. Your risk is that the guy sending in the late bid already knows what the winning tender is, and he's just undercut it by $1,000. So again, it's not technically very difficult. Happens all the time. Once again, recruitment of consultants. We have this guy. He's a really good guy, and in fact, he's just late because he was working on another project, or he forgot, or nobody told him. We're going to take it anyway. Because nowadays it's all done by computer, and the computer will just tell him he hasn't got it automatically. So, acceptance of late bid. And finally, hidden or undeclared interest in the bidding company. So this is a situation when the person in your procurement department has a relationship with one of the bidders. I think when we did, I can't remember, it was in my conflict of interest case studies now. We certainly came across this before in real life, where the woman, it was a lady working in the company, they wanted, I think it was IT, and her husband was one of the bidders. And it never actually occurred to her that she had to declare an interest in that. She had to tell everyone. And in fact, what she did was she waited till he'd won the contract, and then after he'd won it, she went, oh, maybe I should tell people. So then she went and declared that this guy had the interest. Of course, it's, a 3-month computer contract. Do people really want to sit through that all again? Especially when you've got to get people from HR who know nothing about computers and just look at it as a total waste of their time. No. So you have to get people to declare interest in the companies that are bidding. And usually then, they have to recuse themselves, so they have to come off the committees, or the company which is bidding has to say, oh, we're not going to bid for this contract. The problem with it all is it's all a little bit of a pain in the neck and often a little bit unnecessary. But when you get caught and then you're standing there in front of a tribunal going, well, it just didn't really seem that important at the time, you kind of look a little bit dumb and a little bit suspicious. So it's so much better to get this stuff done all up front. And in terms of your long-term career and your long-term revenue earning potential, it's actually much better, to be honest, as well. Okay, you got kind of 5 or 6 slides there which just go through these things. I have to say I'm not really sure that they're in a fantastic order. I think we could have organized that a little bit better. But I think it's all quite interesting. I think what maybe we need to do is do some case studies based around that. So, little job for me next week while I'm preparing to go do this. Okay, thanks for watching. There's another slide. I don't even know how long this stays up for. I have to have a look now. Put another slide up, and the slide will say thank you for watching. You know where we are. Like us on Facebook. Come and find blah blah blah. Come and find our website. Thank you.